Hey everyone, my name is Reese, and in this video, I will be going through some M1 Finance pies, which essentially are portfolios that you can make and allocate different percentages to each ETF or fund. And the point of this video is going to be helping those who are potentially newer to investing or looking into how they can build a fund to meet certain different goals based on their financial needs or what they're trying to achieve. And specifically, I will be looking into M1 Finance, which, just a disclaimer, I am not publicly sponsored by them in any way. I personally have an account with them. It currently has no money in it, but I do think it's a pretty neat tool that you can use, especially for those who are trying to visualize how much they would be investing into what. And so to start off, so this is M1 Finance. M1 Finance is an online broker where their entire basically basis of how they work is you build these things called pies. And in these pies, you invest slices, which are different allocations to whatever ETF or stock you want. And it can be a pretty useful tool because it's nice that as you invest, it automatically rebalances for you in the sense that instead of actually buying and selling your own shares to rebalance, as new money gets deposited into the account, it'll basically buy shares as needed from those slices to rebalance it. So it's pretty cool. Like I said, I personally haven't used them yet, but I think it's a pretty useful tool to visualize different portfolios. And on m1finance.com, they have a section where you can research and go. They call it expert pies, which a lot of it's questionable, but it's pretty nice because you can. It's for good for people who need a place to get started because you can look into like target date funds and where they've done the work for you, general investing. So a lot of this is it's good for helping you get started with learning about what portfolios look like depending on, let's say, if it's a value or growth, domestic, international bonds. And that's just pretty general idea of how M1 Finance works. And I'll be going through 5 different portfolio ideas depending on your goals. And they're going to be a 3 fund portfolio, a growth, value, dividends, and an IRA idea. And like I said before, these are portfolio suggestions or ideas to help those who are looking into trying to build a portfolio around a certain different target. And these are not funds or not portfolios that I'm currently invested in. It's simply trying to help those who try to building a portfolio from scratch can take a lot of work, and so this kind of take doing some of that hard heavy lifting for you. And you can always change the allocations, add in different stocks or ETFs. What you make changes as you see fit. There's no one size fit all. These are kind of just suggestions. So the first fund that I'll be talking about is called a 3 fund portfolio. And what this is utilizing 3 ETFs, which is a Vanguard Total Stock Market ETF, VXUS, which is a Vanguard Total International Stock Market ETF, and then BND, which is a Vanguard Total Bond Market ETF. And the idea of a 3 fund portfolio is that you're taking advantage of international stocks, domestic stocks with VTI, and then bonds. And this is just simple target allocations. This is what's commonly recommended to as the Bogglehead 3 fund portfolio, and this is the Vanguard Trio. Vanguard is nice because they have very low expense ratios, usually in higher liquidity, and it's not something that I'm personally not holding BND. I personally think that potentially buying individual bonds rather than bond ETFs might be a better route depending on your needs, but the idea behind this 3 fund portfolio is that you're diversifying across bonds, international, domestic, in hopes that you're seeking diversification over aggressive returns. And the idea with using bond ETFs is as you're getting older, as you're getting closer to retirement, typically people start scaling back on their stock exposure and start increasing this target allocation. So as I was talking about in these plan for retirement, so let's say 2025 is going to have a lot more bonds in it. Oh, there's a lot of stuff in there. But basically, as you're getting closer to retirement, typically you scale back on the aggressive stocks and start looking into more stable dividend paying funds such as bond ETFs. And going up next is a growth idea. Now, this portfolio is targeted more to be aggressively invested in companies that are focusing on expanding. And these companies are going to usually have higher price to earnings ratios. And another thing that I should have mentioned before is the idea of all these portfolios I'm presenting is that they're based on ETFs. And ETFs are nice because they take the heavy lifting out of all the homework and research that you'd have to do picking and choosing individual companies or stocks. You're basically just buying these ETFs, the homework's done for you, and they will rebalance, move companies in and out of the fund so that when you're buying like a total market US stock market ETF, you don't have to worry about beating the market because you are the market. And then looking into VUG rather than investing in individual growth companies, potentially risking losing it all, investing in a growth fund such as VUG is going to diversify across growth stocks. So it's basically rather than just betting on individual companies in a specific sector, you're basically just investing in the entire sector or category as a whole. And so for this growth idea, like I said, these are all ideas, just trying to show you different ETFs to get it on your radar. You can always fine tune the percentages, ETFs, and move things in and out as you see fit. So this growth fund is basically those who are focusing on much more aggressive risk tolerances. These are going to increase a lot and go down a lot potentially. And so, and the market does tend to cycle between periods of high growth versus value stocks outperforming. So it really just depends on timing the market, which can be a difficult thing to do. But nonetheless, so for this growth idea, this portfolio is based on VOO, which is VOO, Vanguard's S&P 500 ETF, which I still think, regardless of you're looking for an aggressive fund or not, I still think it's good to have a strong core holding such as a total market or S&P 500 fund. So that will be as like a basis of your portfolio. And then in this portfolio, I have 18% allocated to VUG, which is a Vanguard growth ETF, which is basically investing in large cap growth companies who are focusing on rapidly expanding. This is going to be companies like Amazon, Tesla, Google, Microsoft. Those are going to be in your Vanguard growth funds. And then another 11% allocated to VIG, which is Vanguard Dividend Appreciation ETF. And this is focusing on companies that are raising their dividends, they're growing, and they're historically, it's focusing on quality financial companies. And in VIG, some of their top holdings are going to be things like Home Depot, Microsoft, Johnson & Johnson, proven companies that have been growing over in the long run. And so I have 11%. This kind of help give you a little bit boost to dividends, but also growing assets. QQQ is a very popular ETF. It is the NASDAQ 100 ETF, and it is a very aggressive tech-heavy fund. It has, I believe it excludes financial companies or has very limited exposure to them. So it's pretty much all information technology like Google, Amazon, Apple, Tesla, Nvidia, AMD, all these big tech-oriented companies, Facebook, Netflix, and it's has outperformed VUG in certain periods, but as of right now, QQQ is really taking a beating so far this year. And then VBK is a Vanguard small cap growth ETF, and VOT is a mid cap growth ETF. And so using these ETFs is gaining exposure to small mid cap companies that are going to be a bit more risky than your blue chip companies, but it is the high risk, high reward mindset. Moving into a value tilt portfolio. This idea of a value tilt portfolio is basically it's kind of the opposite of investing in a growth company. Your growth oriented portfolio, you're kind of scaling back, focusing on companies with strong financials, going to be higher dividends. For example, the growth fund had that I made was a 1.25% dividend yield, and this value tilt has a 2.41%. So basically double the dividend yield. And so similar, I still think it's good to have a strong core holding. So for VTI is going to be the core holding for this portfolio. And then VYM and VIG and SCHD, so Vanguard High Dividend Yield, Vanguard Dividend Appreciation, and Schwab US Dividend Equity, even split 20% each. And obviously, you can always change things around and move things in and out of these portfolios, kind of just suggestions. Vanguard High Dividend Yield focuses on companies that pay above average dividends, and SCHD is a pretty neat fund that tracks the Dow 100's dividends index, and it's focusing on companies that have higher than average dividend yields, a history of paying out dividends, and growing their dividends. So it's a pretty nice blend of everything. And so this core holding is still going to have VTI is still going to contain Apple, Google, all these big name companies, but you're also getting a little bit more exposure to these value based companies. And VIG has performed similarly to the overall market because it is going to have Microsoft and big name companies in it. Not saying SCHD and VYM don't. It's just you're still getting the growth aspect with this portfolio. And then here's a dividend portfolio idea where it is focusing entirely on dividend paying ETFs that are focusing on long-term growth or long-term dividend growth. And so this dividend portfolio has a 3.04% dividend yield, and the core holding for this is SCHD at 30%. And like I said, this is dedicated to dividends only. It's why I took out VTI and the S&P 500, stuff like that. But so you got the same similar stocks as from before. So SCHD and then VYM and VIG are making up 25% each. And introducing a new ETF called DGROW, which is a dividend growth ETF. It's similar to VIG, just slightly different tweaks. So VIG requires stocks to have a dividend growth of 10 years or more, I believe, and then DGROW is 7 years, so it's a little bit less strict. O is Realty Income Group. It is a very popular real estate REIT that pays a pretty hefty dividend yield. I believe is about 5% so far, 5% as of right now, and they have a very strong history of paying out their dividends. And then another 5% allocation, the HDV, which is an iShares Core High Dividend ETF. And another disclaimer, I'm not saying these are the best or ETFs out there. I'm simply just trying to throw things on your radar for you to hear what they are and do your own research and figure out what makes sense for you. And then next, this is an IRA portfolio idea. So this is for people who are potentially in their 20s or 30s. They have a long time frame horizon. They're putting their money in an IRA where they know it's going to sit until they're 60 or older. And similar to some previous, this is going to have a lot of overlap because I do believe these are very quality ETFs overall. So VTI is serving as the core at 45%, SCHD at 25%, Vanguard High Dividend Yield at 10%, VIG at 10%, and then IJR and IJH are the newcomers here. So the IJR is an S&P 600 small cap ETF, and IJH is an S&P 400 mid cap ETF. So this is giving you some exposure to small and mid caps, and also focusing on some dividend funds because as those dividends are getting paid out over a period of 20, 30, 15, whatever time horizon you have, these dividends are going to be compounding and compounding. And so as you're getting to retirement age, you'll hopefully have a pretty sizable dividend paying portfolio, and that you won't have to really worry about selling as many of these shares. Instead, they'll be giving you a more passive income through dividends. And VTI will be driving the overall growth of the portfolio. So it's pretty interesting things to play around with. I'm going to be providing a link for all of these sample portfolios in the description so that you guys can take a look. I think M1 Finance is a pretty neat tool As I mentioned, I'm not sponsored by that. I'm simply trying to showcase a useful tool that you guys can use to help learn more about the stock market and then investing portfolio ideas. So I hope you guys found this useful. As I said, these are not set in stone hard rule and portfolios. These are kind of just to show you how you can use this tool to kind of just play around with it to create something that's more dividend focused, value focused, or growth focused. I can do another video in the future talking about which category type might best suit you and how you can build a portfolio that suits your needs. These are simply trying to show you some of the common and more popular investment options that people like to take advantage of. So you guys, hope you guys enjoyed the content. Thank you for watching. If you have any feedback or comment suggestions, feel free to leave a comment below. I'd be happy to take a look. Thanks for watching, guys. Hope you guys have a great day. Thank you.